Welcome, everyone, to our first joint webinar hosted by the National Housing Conference and the Homeownership Alliance. Our topic today is Fannie Mae, Freddie Mac, and the future of American homeownership. I want to thank my co-host, Chris Siglin from the National Community Stabilization Trust, who's also a member of the NHC Board of Governors. We'll hear from Chris in just a moment. I also want to recognize the generous support of Wells Fargo, who made it possible for all of you to attend free of charge, given the unique importance of this discussion. Christy Furco, Wells Fargo's Executive Vice President and head of Wells Fargo Home Lending, is also with us. Christy is the incoming chair of the Mortgage Bankers Association. She and I first met when she came to Fannie Mae from the senior leadership of PepsiCo almost 20 years ago. She was hired because of her management and leadership skills, but like so many of us, fell in love with housing and has been a part of our industry ever since. She will be moderating our panel discussion on moving the numbers forward for people of color. I also want to thank all of our panelists and moderators, especially Ann McCulloch, President and CEO of the Housing Partnership Equity Trust and the chair of the NHC Board of Governors. She will be moderating our panel on the enterprise's role in securing sustainable mortgages with a panel of leaders from FHA, FHFA, and the CFPB. Finally, before we get started, I want to invite all of you to join the National Housing Conference if you're not already a member. This is our 90th anniversary year, and certainly one of the most impactful and important in a generation. NHC was founded in 1931 by Mary Kingsbury Simkovich and Helen Alfred as an unlikely coalition of builders, social workers, labor unions, and religious leaders to advocate for the production of desperately needed, quality, affordable housing. Our slogan was "Housing is Jobs," particularly relevant today. Eleanor Roosevelt hosted our first fundraiser and spoke at our inaugural conference at the Willard Hotel here in Washington, D.C. You can learn more about how to join NHC at nhc.org. Chris?
Good morning. I'd like to welcome you all to the event as well. I'm Chris Siglin, and I direct the Homeownership Alliance, a project of the National Community Stabilization Trust that brings together nonprofit affordable homeownership developers and lenders to advocate for policies to increase the supply of homes for first-generation homebuyers. Welcome to today's conversation about how changes in policy at Fannie Mae and Freddie Mac, mortgage lenders, and government agencies can increase access to affordable homeownership as part of the effort to close the racial wealth gap, which is as persistent as it is disgraceful. As many of you know, there is a 30-point difference between the white and Black homeownership rates in our country. This matters because there is no investment that is as beneficial as homeownership for wealth building for Americans. Even without relying on home price appreciation, homeowners benefit from the equity that builds up as they pay down a mortgage. They are paying themselves rather than paying the landlord. This equity can help homeowners in retirement or enable them to tap that equity to start a small business or pay for college. Homeownership also gives families stable housing, which is especially useful if they have children in school, and also stable housing costs because mortgage payments on fixed rate loans don't increase, unlike rents. To quote Mike Lofton of HomeWise, who you're going to hear from later, homeownership is affordable housing. Thus, bringing the wealth building benefits of homeownership to a broader swath of American society is crucial to reducing economic and racial inequality. As you listen to the panels, I hope you'll consider how your work can create a more sustainable path to homeownership for more people. It's going to take teamwork and a willingness to experiment and let go of old ways. I'm looking forward to the conversation. David, over to you.
Thanks, Chris. It's now my pleasure and honor to introduce our special guest, Sandra Thompson, Acting Director of the Federal Housing Finance Agency, or FHFA. In this new role, she has catapulted FHFA's agenda onto the leading edge of affordable housing finance and racial equity. She is the prudential regulator for Fannie Mae, Freddie Mac, and the Federal Home Loan Bank system, responsible for the safe and sound operation of financial institutions that impact 1/5 of the US economy. Before being named FHFA director, Sandra served as deputy director of the Division of Housing Mission and Goals, where she has overseen FHFA's housing and regulatory policy, capital policy, financial analysis, fair lending, and all mission activities for Fannie Mae, Freddie Mac, and the Federal Home Loan Banks since 2013. Prior to joining FHFA, she worked at the Federal Deposit Insurance Corporation for more than 23 years in a variety of leadership positions, most recently as the director of the Division of Risk Management Supervision, which is a key role. During her time at FDIC, she led the agency's examination and enforcement program for risk management and consumer protection at the height of the financial crisis. She also led FDIC's outreach initiatives in response to a crisis of consumer confidence in the banking system. Her experiences range from supervision to consumer protection, risk management, and consumer outreach activities. Quite the list of qualifications for this critically important role. I'll add that she is also a proud graduate of Howard University here in Washington, D.C. So welcome, Sandra.
Great. Thank you so much, David, for that wonderful introduction. And thank you for having me today. It's always a pleasure to spend time with you, and especially in the audience that I have today. So I'm thrilled to be here. So thank you very much.
Well, thanks for being here. And let's get right into it. You have had quite a busy few months since you were appointed acting director. Since then, you've taken on fair housing compliance, racial equity issues, the capital rule, the PSPA restrictions, and duty to serve. I am sure I've missed something. So asking what's next on your agenda is kind of like saying, what have you done for me lately? But we're in Washington, D.C., so I'll ask, what are you doing for me lately?
Well, you are absolutely right. We've been very busy, and every day counts, quite frankly. So we're really busy trying to move forward with the agency priorities. We want to make sure that we have sustainable access to credit, particularly in low and moderate income communities, as well as communities of color. We also want to figure out what the enterprises can do to be helpful in addressing the supply issues that we have. And of course, everything that we do has to be done in a safe and sound manner. And I really liked some of the remarks that were made before we signed on, where sustainability and affordability were interchangeable. We're focused on sustainable mortgages. So we've been actually, as you well know, particularly focused on closing the racial equity gap through homeownership. We asked Fannie and Freddie maybe a month or so ago to submit some equitable housing finance plans. And one of the things that we're trying to do, again, is close the racial equity gap through homeownership. And we thought that having the enterprises develop 3-year plans, and this is again similar to what we've done previously with duty to serve and affordable housing goals, where they submit 3-year plans and articulate kind of what they're going to do in areas to help underserved. We thought that there needed to be a particular focus on equity. The plans from the enterprises are due by the end of the year, and our initial requirements are that the first-year plans really focus on closing the racial and ethnic homeownership gaps by, one, identifying the barriers that have previously existed, especially in places that were previously redlined. So they have to articulate what those differences are, and then they have to come up with measurable and quantifiable activities and initiatives that will address those barriers. You guys know we've had this conversation for, I can't even remember how many years. And so it's just taken too long. And we really want the enterprises to put together some strategies to try to help us move the needle. We had a listening session on the equitable housing plans and what needed to be included in them this week, and we had a lot of participation, had a number of speakers, had great participation in the persons that called to hear. But we really want to get your input and feedback on what should be included in these plans, because we do want to get it right. And I am going to be holding the enterprises accountable for achieving the measurable objectives and goals that they include in their plans. David, we're also working on affordable housing goals. We have a proposed rule and certainly are looking for comments on that rule. One of the things that I'd highlight, because you well know the affordable housing goals have been around for quite some time, but we added a new sub-goal that establishes a requirement for the enterprises to purchase loans in a minority census tract. And previously we had a low income area goal, and it just focused on the enterprises buying loans in areas that were designated as low income. And what typically happened, it didn't really matter. There was no AMI limit. So anyone who purchased a loan in a designated low income area, the enterprises would get credit for those loans. And it did not segment out minority census tracts. And we feel pretty strongly about that. And we have AMI requirements on this new goal. And we want to particularly focus on, communities of color, because in the prior years, we may have unwittingly committed or actually facilitated, gentrification in some areas without the AMI requirement, because you can have high income persons buying properties in low income areas and the enterprises would get credit. So with the new goal, we want to really be focused on minority census tracts, because we think the new goals will help families that are at or below AMI stay in the communities that they help to build. The other thing that I mentioned are the fair lending initiatives that we're working on. You know that we established an Office of Fair Lending in late 2018 and started building that office up in 2019 and really started our exam oversight supervision responsibilities late 2019, early 2020. Some of the things that we've done, we've established a fair lending policy statement, which is similar to what the other bank regulators have done. And it really highlights, one, that we do have this responsibility and that we're very serious about our administration of this responsibility for our regulated entities. We also issued a reporting statement for fair lending, which requires the enterprises to submit information to us on a quarterly basis so that we can kind of monitor what they're doing in the policy area. And we take this role very seriously, and we really want to be focused on making sure that we are protecting and that the enterprises are certainly adhering to fair housing and fair lending considerations. We also, as you know, established a historic MOU with HUD, and we're really excited about it. They have fair lending oversight responsibilities for the enterprises, and we want to work together and share information, certainly so that things are not duplicative. We all will retain, I should say we each will retain our independent authorities, but we just thought it was really important for us to work together on this very important issue. And we've just been really excited about the engagement that we have engendered, not just with the enterprises, but just generally. I think that for me, it's really important as we're looking at regulating and directing through our conservatorship responsibilities, the enterprise's activities. When we're looking at policies, we need to take a holistic view. We need to not just look at, what is this policy and what's the risk management, or what are the risks associated with this particular recommended policy. We need to look at the impact of these policies. What's the impact on fair lending? What are the impacts on affordability? And just really make a holistic decision as opposed to making, individual decisions on fair lending or affordability or risk management. So we've been really trying to move the needle and integrate the mission area and the safety and soundness, because we believe that these two are two sides of the same coin. They're not mutually exclusive, that they have to work hand in hand.
Thank you. And I think that's exactly right. One of the things that was shocking to me when you signed the MOU with Secretary Fudge was that you actually needed to do that at all. I just assumed that you guys were always doing that. And it says a lot about the change in leadership, and also about, we should just never assume that we're being intentional about something until we are. And I also wanted to just say that, I was at Fannie Mae between 1994 and 2006. And in 1996, I opened the Detroit Partnership Office, where really, I like to say, I focused on where the secondary market shovel hit the ground. And for the first 2 years I was there, I had information on and was responsible for reporting on how many loans I made to African Americans, how many loans I made to Hispanics. I knew exactly where my lending was, and I was able to tailor my work on a monthly basis to ensure that I was meeting my goals. I had a report on it quarterly. And then at some point halfway through that 4 years, some clever lawyer in Washington told me that I was discriminating against white people and that we were all going to stop. I'm a white person. I never felt discriminated against, I have to say. But we had to stop reporting on that and use geographic measurements instead. And at the same time, I was told, you are what you track. And I think that is a message we really need to take another look at. This has been something we've commented on to FHFA, as well as the Federal Reserve Board of Governors. I think we have to be intentional, and I really want to encourage you to take a fresh look at that and recognize that we're just going to have to report on what we're doing if we want to see change. We may not be able to tailor loans specifically by race, but if we're not paying attention to that, I just don't think we're getting it done.
Well, I can assure you that's certainly something we're paying attention to. And we get our data, as you well know, we've got HMDA data, but we also get data from the enterprises. So we look at not just their acquisitions, we also look at applications and try to figure out, and we may not look at individual loans, but I certainly have my fair lending office looking at, protected classes, whether it's race, gender, zip codes, et cetera. We cut and slice that data just in every possible way. And you might recall that last month we published some data on the affordable housing goals, like, where are the goals, what classes do they serve? And so we're really trying to be responsible just in terms of getting information, providing information, and then taking action when necessary, because much of what you hear, especially if it relates to race, and this is not going to be new to this audience, it's always, or many times it's anecdotal. And so we've been laser focused on getting and accumulating data and then cutting and slicing and dicing the numbers so that we can really take a good look at what the issues are and what areas really need to be focused on in our thinking and in our approach to policy making, because the enterprises have a responsibility to provide broad access and sustainable access throughout the country. And that's a mandate that was given to them by Congress. And it's our responsibility to make sure that they're doing so. And we can do that responsibly through our collection and analysis of data. So I couldn't agree with you more, David.
I think that's great. And, during our first conversation after you were appointed, we talked about this, and you said, this is existential to their mission. It's in the Safety and Soundness Act. It's in their charters. It's in their in HERA. And in the RFI, you really went to great lengths to cite all of those different elements of the statutory authority. And I think it's really important. It was incredibly refreshing and appreciate that. And I appreciate the transparency in that last report. It was shocking, but also encouraging that we're going to get honest and real about this and move that needle, as you said. Let me ask you about the duty to serve process and the affordable housing goals for the enterprises, and how have you been experiencing that process? You've been involved in that process for a long time under 3 different directors, I think, and 4, and it's hard to keep track. And and we're seeing a shift now. I wonder if you could tell us more about your vision of how duty to serve and the affordable housing goals contribute to these broader national priorities.
Well, for many, many years, the enterprises had just focused on the affordable housing goals and the affordable housing goal requirements. And that certainly provided support to low to moderate income individuals and low to mod areas. And duty to serve really has a focus, as you well know, on really underserved areas, whether it's rural or manufactured housing or affordable housing preservation. And so one of the things that is important that I've kind of figured out is there's no one size fits all box for the enterprises to effectuate their mission responsibilities. So we had affordable housing goals, we have duty to serve. We also use a scorecard to drive the enterprises in terms of meeting their mission and working on things like targeted affordable housing, whether it's single family or multifamily. And so it just shows that the problem is not just focused on, low to mod, it's not focused on individual areas, it's widespread, and you need different tools in the toolbox to address these areas. And I'm really thinking about how do we target individual programs to address the individual issues that we have, because I feel like for so long, it was just affordable housing goals and we focused on the numbers and did the enterprises meet their goals? And then you get caught up in the conversation about, whether or not the goals caused the crisis. And that really takes away from what we're trying to do. What we're trying to do in terms of lessons learned is use all the tools that we have available to us to address the affordable issues around the country in the specific ways that are specific to that particular area of the country or specific borrowers. And we're looking to add to the toolbox. And we think that the enterprise, the equity housing plans would be yet another tool. So we're just trying to take a targeted approach and not try to have this one size fits all answer to address affordability. Every region, every person has individual circumstances, and we need to calibrate what we're doing to try to address these issues in a responsible way so that we are having meaningful progress around the country. The issues in the colonias are different than the ones in the Rust Belt, which are different than ones on tribal locations. And so we've really got to come up with targeted plans under the rubric of affordability to really try to address those areas. So what I've figured out is that, again, there is no one size fits all. We have to come up with different tools. The tools have to focus on sustainability, and we have to measure and report out on what we've accomplished, because if we don't, then it'll just be more conversation.
I agree 100%. And it's, I like to say, if all you have are plain vanilla mortgages, you're only going to serve plain vanilla people. And we got into this crisis of homeownership and the wealth gap and homeownership gap with a century of very intentional housing policy. And we're going to get out of it the same way we got into it, with very intentional housing policy. This is the really core of our Black Homeownership Collaborative that we've worked with such a broad group of members. And and I think there's just a really new focus and intention by all kinds of industry groups, the realtors, the realtists, the home builders, the MBA, as well as traditional groups who've been fighting for this for a generation, like and more, like NAACP and Urban League, and of course the National Fair Housing Alliance. So it's this is a crisis. I think that many people in the country have embraced it as such, and we're going to have to move the dial and get these numbers up, or we'll fail in so many other ways.
No, I agree with you, and I might just add. I mean, you're exactly right. And everybody that I've talked to, we've done a lot of outreach, and then people are calling, and they're like, "Well, what can we do to help?" And it's all stakeholders. I just think that we are at a moment in time now where people are focused on this issue. And if we don't take advantage of the opportunity to do what we can right now while people are asking, what can we do? How can we help? Are there things that we can contribute? I just feel like we would be missing a real opportunity to really move the needle.
So let's widen the lens a little bit and talk about production. America's housing crisis is really a crisis of supply right now. And many of us have been fighting for down payment assistance. I'm hopeful that we're going to get some in the reconciliation bill. I'm hopeful we're going to get a lot. But it is not going to be impactful if we don't also address the supply side. Because as housing prices rise, it depreciates all of our investments in creating affordable housing, because it becomes less affordable or subsidies get constrained more. So let me ask you, how can the enterprises contribute to increasing supply and really leveraging their role in the housing economy better?
Sure. So we're working really closely with Fannie and Freddie to look at ways they can increase the affordable housing supply. You might know, certainly and are aware that we increased their ability to invest in the low income housing tax credit. So their allotments were $500 million, and now they're $850 million. So each enterprise is now allowed to allocate $850 million in LIHTC investments, and half of the 850 has to go be deployed in areas where it's really hard to find other investors. As you well know, there's many investors in LIHTC, but we want the enterprises to focus on providing liquidity in some of the harder, the areas where in the underserved areas where people just are not as prevalent, where the investors aren't as prevalent. We've also asked them to take a look at the accessory dwelling units, the ADUs. We had a listening session on that. We're looking at some of the policies that they have in place, the purchase requirements for ADUs. But I would say that there are some areas where the local zoning and ordinance requirements are a little prohibitive. So we're asking, people for feedback on that. And we're also looking at things that we could do in the manufactured housing space. And certainly those are homes that are less expensive to build, but manufactured housing for some kind of means, I guess, trailers, but that's not the manufactured housing that we're talking about. And we're really looking at ways to try to figure out how to get, how to increase supply, especially at the entry level space, because as you well know, these high housing prices are really squeezing the first-time home buyers and the first-generational home buyers. So we've got the enterprises working on that, and it's not going to be, at the end of the year, we're going to be working on this incrementally. And I think you've seen some of the steps that we've taken in this area, but we certainly are open to and willing to listen to any ideas that people have about supply. We also looked at the REO inventories of both Fannie and Freddie, and I don't think they have 9,000 loans between the two of them. We were looking at, what's going to happen after the foreclosure moratoria ends at the end of the year. but I just don't see that there's going to be a lot of movement. And I mentioned in another conversation that I was having earlier this week that I'd also tried to take a look at the balance sheet of some of the larger banking institutions. And quite frankly, they don't have a whole lot in REO as well. And so, we're really focused on how we, the enterprises, can help in the supply area, particularly around the entry level, first time and first generational home buyers. So if you guys have some ideas, we're certainly open to them.
I think that's great. And let me just dive a little deeper here, and because this is something I've talked to home builders about for years, and it really is a key issue, which is the lending for acquisition, development, and construction, also known as AD&C lending. People have talked about Fannie and Freddie being able to do lending. I wanted to ask you about how we do that safely, and is it charter compliant?
Well, two things. One, Fannie and Freddie both have what we call C2P, construction to perm. They purchase the C2P loans, but the loans have to be made before the enterprises can purchase them. So they have certain lenders around the country that are, aware and is very active in the C2P. We've got single close loans where you can close on the, construction loan after it's closed and then the purchase. And then you've got the dual close loan. So we're also looking at that. The enterprises are not allowed to, facilitate construction loans, but they can purchase the loans once they're made, once the construction is done and the loan is made to an institution. And so they can work with lenders to try to figure out the best way to take advantage of some of the C2P requirements that are in place now. But we are looking at that, and the enterprises are working with certain lenders on C2P.
Because of course they have.
Yeah,
go ahead.
No, I was going to say that, the ADC loans, after they're constructed, it's within the enterprise's charter responsibilities, and the charter does allow them to buy the loans, but the loan has to be made.
Well, and I think we have done this in the multifamily space and also in the single family rehab space. So yeah, it may be useful to look at the construction of single family homes as well, where obviously there's a difference in ownership with the single family rehab. But
no, I agree. And you did mention rehab. Both enterprises have, reno programs and rehab programs, and we're looking at those as well. So as I said, there are just a host of things that we're looking at, and what changes do we need to make? What tweaks do we need to make? Are there things that we could do to be helpful in the supply area, whether it's C2P, whether it's making tweaks to the reno and rehab programs? So we're really looking at that, because new supply, as you well know, doesn't always have to mean a new building. It could be repurposing or renovating existing property. So we're just looking at the gamut, quite frankly.
So, we have a credit box today that is pristine. Many of us think it's too small. The average credit score for the enterprises is over 740. We also have loan level price adjustments that have been in place since the financial crisis. And I think, aren't we really asking the people who need affordable housing the most to pay more? Tell us a little bit about how you're looking at these issues, and are you open to eliminating LLPAs?
So let me go credit score first and then LLPA. So I think the credit box itself is not too small. I would say it's not being utilized, because the eligibility requirements for Fannie and Freddie to acquire loans, I think everybody knows what the requirements are. The acquisitions today, it is a pristine box in terms of looking at the credit scores and in terms of looking at LTVs, although I have to really think twice when I think about current LTV because of the increase in home prices that's been taking place over the past year or so. But that's a whole nother issue. So underwriting, as you well know, and I think Fannie and Freddie are really getting to this place where it's not just about credit scores. You do know that Fannie Mae actually is incorporating rental payments, like the 12-month positive pay, in their underwriting criteria as we try to, again, move the needle for first-time home buyers. And just looking at, credit scores a little bit differently. As you well know, credit scores used to be, or maybe still are, based on ability to repay debt. And when you look at the rental provisions, that's the ability to repay a contract. That's a contractual agreement as opposed to a debt, just in definitional terms. And I just think, like the housing expense for most people is the largest monthly payment that they have. And that's true whether you are renting or whether you're purchasing, if you're just a regular normal person. And I just think we need to rethink about, how the factors that we use to determine whether or not an individual has the ability to repay. I think that for me, it just made no sense to ignore the information that you can get based on someone's rental payment history. I mean, the other things that probably should be taken into consideration, especially given, today's generation and our utilization of technology, the repayment of, cell phones and just other non-traditional things that people are doing that probably need to be incorporated into the totality of underwriting. There was some pushback that we got, that Fannie Mae got when we announced the rental requirement and that we were going to incorporate it. And people thought, that's a big, you're opening the credit box, you're doing all these things, and that's really not a good indicator. Well, that's not the only indicator that, goes into consideration when you're underwriting loans. And, from our perspective, again, a 12-pay clean month rental history in conjunction with other factors is really, really, and can be really, really important when you're evaluating somebody's ability to and willingness to pay. And you well know that the rental payments, especially in urban areas like DC or Chicago and New York, can be really high. And so, or as high as mortgage payments. And so not taking that into consideration just didn't make sense to us. And at the end of the day, I think we all want to make sure that credit is actually given to credit-worthy borrowers, and just how we look at credit probably needs to change. And so we're really being thoughtful about that. With regard to the LLPAs, I would say that, they were put in place during the crisis. And if you look at the grids that comprise the LLPAs, you'll see, they're based on the risk characteristics of a particular loan. I'd also say that for the first-time home buyer programs, especially Home Possible and Home Ready, which are the flagship programs for Fannie and Freddie, the LLPAs are capped. And if the loans have an 80% or higher LTV, then the LLPA is waived. And there's also additional considerations, like there's a $500 credit if a borrower takes a home education or home counseling program. And so we think that if you look at the grid in totality, you'll also see for certain product types that the LLPAs are higher. I mean, that the statute allows Fannie and Freddie to take a lower return on certain loans. And so there are areas where pricing is higher on the grid so that the higher priced or lower risk loans can be used to subsidize some of the more risky or loans with more risky characteristics. So we think there's a balance there. One of the things that we committed to doing was taking a look at pricing. We haven't done a holistic review of the Fannie Freddie pricing analysis, G fees, and just everything that comprises the guarantee fees and the pricing for enterprise loans. So we are going to take a look at that. It is on my to-do list, but I think that for the affordability, focusing on the LLPAs, they're capped in for loans with certain risk characteristics, and then they're eliminated for loans with that have LTVs over 80%. And so that's something that we are going to be looking at, David.
Well, that's good. We're going to have a lot more to say on that, as I'm sure you'll be hearing from other members of the Black Homeownership Collaborative and the collaborative as a whole. I want to be respectful of our time and stay on schedule. I would love to take a swan dive into the weeds with you on capital and conservatorship and PSPAs, but we're going to have to do that in another time. I will finish just with this last question, which is, I think many of the assumptions and questions that are raised in the RFI and that we've talked about today are likely to provoke a backlash. Renewed arguments that Fannie Mae and Freddie Mac caused the financial crisis, that the loans were, if we delve into this area again, we're going to see a repeat. And I think that would be obviously very tragic. We don't want to make the mistakes of the past. We certainly don't want to set people up for failure. But I do think that so much study has been done to suggest that there's so much more that we can do in this space responsibly. And I just want to know how you would respond to those concerns and allegations, and how we should be thinking about that.
Well, I would not respond favorably, because I think today, we've taken a lot of the lessons learned in the past. We're talking about sustainability and affordability. Those are interchangeable as far as I can tell. You talked about the most recent crisis. And I certainly, before I came to FHFA, I served at FDIC, I think you mentioned this earlier, for 23 years. And I was the head of bank supervision. My name had to go on every case that went to the FDIC board for every single bank that was closed during that time. I have had a front row seat, and I've seen firsthand what happens when you have irresponsible or unsustainable lending. And that's not something that I ever want to repeat, or that I would, in my role as supervisor, would allow Fannie or Freddie to repeat. A lot of the issues that took place in the Great Recession, certainly those loans are loans that Fannie and Freddie can't even buy anymore. The 228s, the 327, the predatory practices that took place primarily in African American and Latino communities, where people had loans they didn't understand, loans they couldn't afford. So they get the home, but you can't keep the home. That's a lose-lose trade all the way around. It doesn't make any sense whatsoever to give somebody a loan that they can't afford. They lose their homes, the investors lose, servicers lose. It just doesn't make any sense. So we are not going back to whatever took place in the Great Recession, or even leading up to that. We can responsibly make loans to people that have the ability to repay, and sustainability is critical in everything that we do. We will not be going back to whatever the practices were. And every time, when I made the PSPA changes, when we work with Treasury to look at those changes, we take care of those things as supervisors. That we have those responsibilities either through our authorities as supervisors or our authorities as the conservator over Fannie and Freddie. And so we are risk managers at heart, with an affordability lens. But again, those two are interchangeable, and you can't have one without the other. And I'm very quick to correct people who believe that, oh my God, here she is opening the credit box and it's going to be back to the issues and the results of the Great Recession. That's not going to happen. We are focused on sustainability, which means responsible credit. It means giving people loans that they have the ability to repay, and making sure that Fannie and Freddie are in a position to have the eligibility reflect and target, the people that can afford to repay those loans. And sometimes those loans with some of the more risky characteristics have compensating factors. People have down payment or they've got reserves. They've got lots of different things that can be helpful in taking a holistic view of a borrower's ability to repay. And I'm going to stop there because that topic really gets me all worked up. So I will stop there and just thank you for asking that question.
Well, thank you. It can get me worked up too. And I think it's a good discipline. And as we address this, for me in particular, this is not about questioning people's motives when they raise these concerns. I think they're valid concerns. There's also data-driven responses. And we need to have the discussion around what the data says and what the history is, and educate people to know that, no, we are not interested in turning the American dream into an American nightmare. We know what that looks like, and we've taken enormous precautions to ensure we don't do that again.
Ditto. I couldn't agree more with that statement.
So thank you so much. I appreciate your time and your incredibly important contribution to all of our work, and not just now, but over the course of your career. And I'm looking forward to working with you.
Great. Thank you for having me, and thank you, everybody. Have a wonderful rest of the afternoon. Take care.
Thank you.